Welcome to the halftime report for 2015. My name is Gardner Sherrill. I'm the owner of Sherrill Wealth Management located in Bradenton, Florida. Today I'm going to review the markets for the first half of 2015. We address real quickly a quick disclaimer. The opinions voiced in this material are for general information only and not intended to provide specific advice or recommendations for any individual. Please consult with your financial advisor. 2015 has been full of unexpected surprises, from unanticipated central bank moves to negative interest rates. As Oscar Wilde stated, to expect the unexpected shows a thoroughly modern intellect. Today we will review what's happened year to date, where we are now, and what may be ahead of us. Where we've been. Well, in a nutshell, 2015 can be summed up with the word Deflategate. Yes, the New England Patriots were embroiled in a scandal once again, but this time I'm speaking to the flat markets we've had so far this year. 2015 could be called the year of expecting the unexpected. For the past 12 months, the leaders continue to be real estate investment trusts in the S&P 500, but for the year so far, markets have been predominantly flat, with international markets leading the pack. So far in 2015, with the exception of the NASDAQ, benchmark U.S. stock markets have not made significant gains. The Dow lost 1.14% through June 30th, 2015. The S&P 500 gained 0.2%, and the NASDAQ was up 5.3% for the period. Economic performance in the U.S. was lackluster as well. While unemployment has improved and inflation remains below Fed targets, gross domestic product has slowed during the first quarter. As you can see in the chart, real gross domestic product increased during the first 3 quarters of 2014 before being capped out in the third quarter. GDP growth has slowed since. The advanced estimate released by the Bureau of Economic Analysis revised the first quarter GDP to a mild increase of 0.6%, followed by 2.3% in the second quarter of 2015. According to The Economist, several factors have contributed to slower growth in the United States, including lower oil prices were responsible for slower economic growth as investments in mining structures shrank. The US dollar has gained 20% in value against the euro during the past year, which made exports more expensive. We've had a decline in exports, which were down about 3% year over year in March. American consumers didn't spend as much as the experts anticipated they would, despite the lower oil prices. Lower than expected spending may reflect weak wage growth. And finally, despite 5 years of economic growth, real wages in America remain 1.2% below wage levels at the start of 2009. While U.S. growth has slowed, in the Eurozone has seen some acceleration. Many of the country's largest economies, including those of Spain and France, delivered relatively strong GDP growth during the first quarter of 2015. As a whole, the Eurozone grew by 0.4% during the quarter, outperforming the United States. The European Central Bank took a page from the Federal Reserve's playbook and began a round of quantitative easing. The goal was to spur economic growth, and so far it's proved effective. The euro area began showing signs of recovery. The euro lost value against the US dollar. Eurozone's exports increased, and the Eurozone consumers have been spending the windfall created by the lower oil prices. But not all central banks were as successful as the ECB's. Most central banks like to take things slow and make sure their actions are predictable. This was not the case with the Swiss National Bank. In January, anticipating the ECB's announcement that it would engage in quantitative easing, the Swiss National Bank decided to remove its very unpopular currency peg. The response was unexpected. To quote, currencies don't normally move that far on a daily basis. 2 to 3% is a big shift. The exception is when a country on a fixed exchange rate suffers devaluation. Then a 20 to 30% fall is a possibility, but a 20 to 30% plus upward move is almost unprecedented. That, however, happened to the Swiss franc on January 15th. The Economist, January 15, 2015. Experts speculated about the Swiss National Bank's motive. One suggested by removing the cap and dramatically lowering its interest rate, the SNB could weaken its currency. If that was the S&B's intention, they were probably pretty surprised by the results. The S&B's unexpected action has serious consequences. The Swiss franc to gain about 30% against the euro, many world stocks to slump before recovering, the Swiss stock market to lose about 10%, some currency brokers to become insolvent, central bank loans and mortgages susceptible to default, and West Ham United to lose its shirt sponsor. Some consequences were relatively short-lived, some were not. The euro area was full of surprises during the first half of 2015. Defying conventional wisdom, interest rates in some euro area countries dropped below zero. European countries, companies, and entrepreneurs were getting paid to borrow money. And ordinary Joes with money in some European banks got letters saying that the banks would be charging to hold their money. The New York Times reported when Eva Christian, an entrepreneur in Denmark, got a call from the bank about a business loan she had applied for. To quote, Ms. Christian, a 36-year-old entrepreneur, had been approved for a small business loan. Her interest rate was negative 0.0172%, less than zero. While there would be fees to pay, the bank would also pay interest to her. It was just a little over $1 a month, but still. These are strange times for European borrowers, as if a wormhole is opened up to a parallel universe where the usual rules of financial gravity are suspended. Of course, negative rates also mean depositors pay the bank for holding their money. Negative interest rates encourage banks to lend and make savings less attractive. When people lose more money each year to inflation, they gain from interest. Savings becomes a losing proposition. Consequently, investment and consumption should increase and stimulate economic growth. ECB stimulus and negative interest rates spurred economic growth in the euro area, which helped the European stock markets become more attractive to investors. National benchmark indices for the France CAC and the 12 were up 12.11%, and the Germany DAX up 11.62%. Have delivered attractive performance through June 30th of 2015. The United Kingdom's FTSE was down negative 0.68. International markets are doing a lot better this year in general than they did last year. The ECB wasn't the only central bank pursuing quantitative easing. The Bank of Japan is widely credited with inventing quantitative easing. It tried quantitative easing back in the turn of the century and has applied it liberally since then in an effort to encourage growth. Its economy has been in a slump that owes much to deflationary pressures, an aging population, and a declining workforce. This time around, the intent of quantitative easing was to push inflation higher, up to 2%. The effort was foiled by low oil prices, which pushed inflation towards zero. The value of the yen dropped with quantitative easing, and given enough time, experts say low oil prices and weaker yen could lead to higher inflation and economic growth. However, there's no guarantee oil prices or currency values will remain low. Japan's quantitative easing may not have had the desired economic effect, but the country's stock market delivered stellar performance during 2015. Reuters reported, as has been the case elsewhere, quantitative easing is creating a world of investors that the look of corporate profits have been at record levels. Exports have been down, but when translated into yen, the goods sold have yielded greater profits. The gaps you see are unreported performance dates on Yahoo Financial and Google Finance. India did not benefit. The S&P BE Sensex index was up just 1.02% through June 30th. However, some Asian markets have delivered attractive growth year to date. Hong Kong benchmark Hang Seng index was up 11.21% through June 30th. Japan's Nikkei was up 15.95% for the period. China's SSE was up 32.23%, and that was after the market had given back some gains during the past 2 weeks of the period. China's markets did so well they were worth $10 trillion in late May, according to CNN Money. The Shanghai Composite Index was up 60% for the quarter. If that leaves you wishing you had more invested in China, bear in mind these words of caution offered by The Economist. At least 80 listed Chinese firms changed names in the first 5 months of this year. A hotel group rebranded itself as a high-speed rail company, a fireworks maker as a peer-to-peer lender, and a ceramic specialist as a clean energy group. Their reinventions as a high-tech companies appear to have less to do with the gradual rebalancing of China's economy than with the mania sweeping its stock market. Examples of excess abound. A pet food company trades at 221 times earnings, a sauna maker on 285, and a manufacturer of fans on 732. Chinese stocks have long had a tenuous relationship with economic reality, but the current rally has gone to new extremes. The Economist, May 30th, 2015. Chinese investors' extreme enthusiasm diminished late in the first year. The SSE composite rose more than 59% from the start of the year through June 12th, when it peaked. From June 12th through June 30th, it fell more than 17%. During the last 2 weeks of June, China's first bull market came to an abrupt end. Chinese stocks weren't the only volatile investments during the quarter. Government bond markets were remarkably volatile. For decades, government bonds have been sought as safe havens during tumultuous times. So far, during 2015, they've been providing the tumultuous times. Government bond values in the United States and overseas have been volatile, Barron said, of the problem is a lack of liquidity in fixed income markets. Liquidity is said to be at a low ebb in the financial markets, especially for bonds. As a result, transactions that once didn't cause prices to budge now seem to be lurching from trade to trade, and the advice from central bankers on both sides of the Atlantic about this new volatility. Get used to it. Barron's, June 6, 2015. Why are bonds so volatile? Barron suggested two possible reasons. The first is that high-frequency trades driven by computer algorithms resulting in herding behavior. Volume is concentrated at the open and close of each day, worsening liquidity during the rest of the season. The second reason is the relative scarcity of market makers. In the past, banks made markets, buying and selling for their own accounts, which created liquidity. But new post-crisis regulations have curtailed those activities. No matter the reason, government bonds haven't been behaving in the way markets expect. In fact, when you consider what's happened across markets and economies so far, a good slogan for the first half of 2015 might be, expect the unexpected. Now, let's take a look at where we are. Well, we're embroiled in another sports scandal. It's soccer this time. The U.S. Attorney General leveled federal racketeering, wire fraud, and money laundering charges against 9 current and 7 former FIFA executives after lengthy investigations into FIFA that uncovered decades of bribery totaling more than $150 million. It'll be a while before we know how FIFA's woes are resolved, so let's turn our attention to economics. Things look a little rosier for some countries than others. Quantitative easing helped encourage economic growth in Europe during the first half of this year. However, events in the late quarter had a dampening effect. As the second quarter ended, Greece was unable to reach an agreement with the International Monetary Fund, the European Union, and the ECB on a package of reforms. Greece failed to make a loan repayment of 1.5 billion euros to the IMF, joining Sudan, Somalia, Zimbabwe, Cuba, Cambodia, and Honduras, who also have failed to repay IMF loans in a timely way. Greek banks and stock markets closed for more than a week. Greek voters rejected the EU's bailout offer. The Greek finance minister resigned. Everyone was waiting patiently to see whether the EU would bail Greece out or not. Ultimately, Greece capitulated and the latest debt squeeze was resolved for now. But turmoil in the EU could affect monetary policy in America. Everyone has been wondering when the Fed will begin to raise interest rates and how global markets will react when they do. It's possible events in Europe will delay Fed action. Chairwoman Janet Yellen said, "In the event that there is not an agreement, I do not see the potential for disruptions that could affect the European economic outlook and global financial markets. I would say that the United States has very limited direct exposure to Greece, either through trade or financial channels. But to the extent that there are impacts on the euro area economy or on global financial markets, there would undoubtedly be spillovers to the United States that would affect our outlook as well." Even if matters in the EU are resolved, it's possible issues in the United States will delay a rate increase. The Fed was expected to raise Fed funds rate when unemployment in the United States was 6.5% and inflation was about 2%. Today, unemployment is below 6% and inflation is expected to near 2% in 2016. However, the math behind the rate hike has become more complicated. It now factors into growth prospects. To quote, the Federal Reserve's forecast for economic growth this year and for interest rates in the coming 3 years could be edging down. If the Fed's longer run growth forecasts deteriorate, it might mean officials believe the economy can't handle rates going very much higher. From the Wall Street Journal on June 11th. One thing some experts say has been holding back growth is the wealth gap. A paper from the Organization of Economic Cooperation and Development reviewed 20 developed countries and reported the wealth gap is the widest it's been in 30 years. Across nations, the top 10% of the wealthiest households hold half of all the wealth. The next 50% hold almost all the rest. Those in the bottom 40% of all households just hold over 3% of all wealth. The OECD report income inequality slows economic growth. Income inequality has a sizable and statistically negative impact on growth. Moreover, the data collected from the think tank's 34 rich country members suggests it's inequality at the bottom of the distribution that hampers growth. In the United States, some cities and states are making changes that will affect income levels for people who earn minimum wages. The Los Angeles City Council voted to raise the city's minimum wage from $9 to $15 an hour. The increase will be implemented gradually between 2015 and 2020. So the question is, did the minimum wage really need to increase by 2/3? According to researchers at MIT, it did. An individual living in Los Angeles, Long Beach, Santa Ana area who was a sole provider for his family and worked 2,080 hours a year would need to earn about $29.84 an hour to earn a living wage and $9 an hour just to live at the poverty level. Consumers of all wealth levels have benefited from lower oil prices. Lower oil prices have proven the resilience of U.S. oil producers. The main lesson is that although the price drop has been bad for producers in such places as the North Sea, it has not derailed America's oil boom. Indeed, America is replacing Saudi Arabia as the world's swing producer. While the United States has long been recognized as an economic power, some believe our influence is declining. Well, the 20th century was a century of the U.S., the 19th century was the century of the UK, the 21st century will be the century of Asia, and is becoming more and more evident, and especially in China. So says Jim Rogers, who's the co-founder of the Quantum Fund. During the first half of 2015, China launched the Asian Infrastructure Investment Bank, as well as some other new institutions to fund infrastructure needs across Asia. It announced the following members in April of this year. 57 countries joined the AAIB, which is more than 1/4 of the world's nations. 16 of the world's 20 largest economies are members. The exceptions are the United States, Japan, Mexico, and Canada. Nearly all Western European countries joined. Belgium and Ireland did not. China will remain firmly in control as non-Asian countries can hold no more than 25% of the bank's shares in total. The Economist reported the AIIB is one of a number of new institutions launched by China, apparently in frustration at the failure of existing international order to accommodate its astonishing rise. Efforts to reform the International Monetary Fund are stalled in the American Congress. America retains its traditional grip on the management of the World Bank. The Asian Development Bank remains based in Manila, but directed by the succession of Japanese bureaucrats. So China is building an alternative architecture. China's alternative architecture that may become quite influential in Asia and elsewhere. Any questions about what's happened during the first half of 2015 and where we are today? Let's turn our eyes to the future. It's hard to know what's on the horizon. Another sports scandal, continued economic improvement, an economic decline, bull markets, bear markets. Let's see what the experts have to say. Although he said he hopes he's wrong, Larry Summers believes developed nations may be suffering secular stagnation. If secular stagnation was emerging, what would one expect to see? One would expect to see that the world real interest rate, or the real interest rates of those places where secular stagnation was a pressing problem, were chronically declining. Indeed, what you see here is that for some long period of time, the real interest rate has been in substantial decline. So says Larry Summers. Secular stagnation is characterized by low or no growth, weak inflation, low interest rates, savings exceeds investment, European consumers will spend the low oil price windfall. Ben Bernanke's inaugural blog posting challenged Larry Summers' views on economies and secular stagnation. Summers responded it was an economic throwdown. Two of the biggest names in macroeconomics met on the battlefield of the blogosphere last week. Former federal chairman Ben Bernanke and former Treasury Secretary Larry Summers were debating why interest rates are so low. For more than a year, Mr. Summers has advanced the theory that secular stagnation is to blame, a chronic shortfall in demand. Mr. Bernanke disagrees, blaming the combination of cyclical and special factors. The International Monetary Fund has a positive short-term outlook. Relative to last year, the outlook for advanced economies is improving, while growth in emerging markets and developed economies is projected to be lower, primarily reflecting weaker prospects for some large emerging market economies and oil exporting countries. The economists reported for the first time since 2007, the IMF expects every advanced economy to expand. Growth in the developed countries should exceed 2% for the first time since 2010. When the IMF looks to 2017 and beyond, however, they say growth may slow. Advanced economies are projected to grow at modest rates from 2017 onward, reflecting the gradual closure of output gaps, particularly in the euro area and the United States, where the persistence of crisis legacies and policy uncertainty play a role, as well as the effects of demographics on labor supply and hence the potential output. When the IMF looks at 2017 and beyond, however, they say growth may slow. Ken Fisher is optimistic about financial markets and believes the bull market has further to run. You've seen the headlines: China meltdown, Greece collapsing the Eurozone, Brexit, risk bashing UK businesses, US debt bomb, Europe's quantitative easing failing, stocks overvalued. Widely known fears aren't risks, they're gifts. Stocks climb the wall of worry until investors are out of worries and become euphoric, or until a huge nasty surprise knocks them. Size and surprise or euphoria, we have neither now. Instead, worrying keeps expectations low and euphoria at bay, lengthening our bull market. Bill Gross disagrees. But now successful, neither perma-bearishness nor perma-bullish managers have spoken to a sense of ending as well. Stanley Druckenmiller, George Soros, Ray Dalio, Jeremy Grantham, amongst others, warn investors that our 35-year investment supercycle may be exhausted. They don't necessarily counsel heading for the hills or liquidating assets for cash, but they do speak to a low future returns. Some say the market's future depends on Fed actions. One expert writing on the BlackRock blog commented, when you look at the S&P 500 performance during rate cycles for various periods going back to the 1970s, a clear pattern emerges. Regardless of the period, 3-month returns following the start of the period of steady tightening were on average negative and more volatile, as markets initially reacted negatively to the start of the tightening cycle. However, looking out 6 or 12 months, markets rebounded and generally produced positive, albeit subpar returns. The chart below, looking at the forward 3, 6, and 12-month returns on the S&P 500 following an initial change of the federal funds target rate, shows this pattern. So there are those who believe the pain will be short-lived, and those who don't. The Economist report some experts fear this time might be different. Central bank support for markets since 2008 has been unprecedented, not just near zero rates, but also buying assets through quantitative easing. Analysts at Societe Generale a French bank, pointed out that there have only been two periods in which American stocks rose as quickly in 6 years as they have done since 2009. In both cases, 1923 to 29 and 93 to 99, a bear market quickly followed. It's clear from the past few slides, forecasting is not easy. How difficult is it? An analysis of pundit accuracy completed in 2012 found market gurus are right about 46% of the time, less often than flipping a coin. That may explain why for every opinion, there's a counteracting opinion. Today, a lot of very smart people have different ideas about what may be ahead for the global economy and world markets. It's a good time to remember that no matter what happens during the rest of 2015, there are likely to be opportunities for investors. They may be in particular markets or sectors or industries or regions, and they may have risks and you need to understand before deciding to invest, but there is usually opportunity to be found. Have a plan for pursuing your goals. Have a process for sticking to the plan. Have a plan for sticking to the process. We spent a lot of time today discussing the outlook for world economies and markets. It's just as important for us to know how your lives may be changing in the coming year. Maybe there's a marriage or a new grandchild on the way. Maybe an illness has cast shadow on your household. Maybe you're considering a new retirement date. No matter what's happening, life challenges play an important role in determining the financial strategies that might be right for you. Please let us know about any changes that might be coming up. I can assure you that no matter what 2015 holds, we will be here to help. Our disciplined investment process was designed to help you pursue your financial goals. While we monitor economic and market developments closely, we don't let the noise of day-to-day events determine our actions. We will not take action until our process indicates we should. We have confidence in our process. It's the reason we sleep at night. Do you have questions about what we've covered here today? Feel free to call me at the contact information below. Some quick information about domestic indices that we've spoken to. Further about international index descriptions. And with that, I wish you the best in your second half of 2015. Thank you for watching.